earnings before interest and tax. Candidates, this one is self-explanatory. EBIT, I can say, represents the company's core profit. It is a measure of the company's core profit. Profitability. EBIT is a measure of a company's core profitability. Core profitability. Let me be specific. Core profitability. It is the profitability of a company before taking into account interest and taxes, operating profit. EPS, on the other hand, the earnings per share. Earnings per share. Earnings per share is a portion of a company's profit allocated to each outstanding common share or ordinary share. And it is a key metric used by investors to assess a company's profitability. Earnings per share, it is the portion of the company's profit allocated. It is the portion, it is a portion, it is a part of the profit that is allocated to each outstanding common share. Common share is also known as the ordinary share. Now I want you to really understand this. I repeat what I did here last time. In computing the profit, candidates, we normally have earnings or revenues or sales. Okay? Then from these sales, we deduct operating expenses. We deduct operating expenses to get what we call earnings before interest and tax, or operating profit. Then out of this EBIT, we may deduct the interest, which is an expense, to get earnings before tax. Then we deduct the tax. This will give us the earnings after tax. Okay? Then from the earnings after tax, we may pay preference, dividend, preference dividend. What remains here is the earnings after tax, but these are earnings attributable to ordinary shareholders, those who are holding the common stock. So the company may choose to, depending on the dividend policy, the company may choose to pay dividends. That is ordinary dividend. But this is the earnings. Okay? It is this earnings that is attributable to ordinary shares that we divide by the number of common stock, the outstanding ordinary shares, to get the earnings after tax. So EPS is the portion of a company's profit allocated to each outstanding common stock. If a company has a 100% dividend payout ratio, 100%, then this will be the EPS. If it is 50% dividend payout, then it will be half of it. Now, indifference point. What is the indifference point? Point of indifference. Point of indifference. Point of indifference. What is it? Point of indifference. Now, this is the EBIT level at which the EPS is the same. Indifference point is the EBIT level at which the EPS is the same for two or more financing options. Did you get that? We are comparing two financing options. So the indifference point is the EBIT level at which the EPS is the same for two or more financing options. This is the EBIT level at which the EPS is the same for two or more financing options. And what are financing options? Financing What are financing options? Now, this can include debt financing like bonds or loans, and equity financing like issue of common stocks. Financing options. There are two general categories: debt financing, equity financing. Now, candidates, the subtopic is analysis of EBIT and EPS at the point of indifference. Now, you may be called upon as a finance manager you may be tasked with evaluating the impact of different financing options on a firm's EPS based on its earnings before interest and tax. And such analysis involves determining the indifference point where the EPS is the same for all options, and then identifying the EBIT ranges where each option becomes more advantageous. Let's reinforce what we are talking about here with an illustration. Donut Limited has a capital structure that consists of 150 million shillings, 15% debentures, and 450 million in ordinary shares of 20 shillings per value. The company adopts 100% payout ratio as its dividend policy. Donut Limited has a capital structure that consists of 150 million, 15% debentures. So debentures, 150 million. And 450 shillings million in ordinary shares of 20 shillings per value. The company adopts 100% payout ratio as its dividend policy. What does that mean? That means that the company pays all the earnings in dividends. There is no retention. The earnings after tax are distributed 100% to the shareholders. That's what we are referring to as 100% payout ratio. The finance manager of Donut Limited intends to raise an additional 20 million shillings to finance an expansion program and is considering 2 alternative financing options. So far, candidates did everything I think you've understood. This is plain English. Plain English. We are discussing this topic in English language. All right. The finance manager of Donut Limited intends to raise additional 20 million shillings to finance an expansion program and is considering 2 alternative financing options. Option 1, issue a 12% debenture stock. Option 2, issue additional ordinary shares of 20 shillings per value. That again is straightforward. There is no vocabulary there. Then we read the corporation tax rate is 30%. That is clear English. Corporation tax rate. That is a rate. You see, it has a percentage. It is a percent sign after 0, the 30%. Required, calculate the earnings before interest and tax and earnings per share. At which point? At the point of indifference in firm's earnings under financing option 1 and 2 above. Option 1 is issue 12% debenture stock. Option 2 above is issue additional ordinary shares. All right. Do you see that? Have you understood the question? Calculate earnings before interest and tax and earnings per share at the point of indifference in firm's earnings under financing option 1 and 2 above. In our illustration, the EPS will be the same for option 1 and option 2. Option 1 and option 2. If you are too tired to remember too many things here, candidates, just pick this. At the point of indifference, the EPS of financing option 1 is equal to the EPS of financing option 2. If there are 3 options, then it will again be equal to EPS for financing option 3. Our illustration only has 2 options. You have to calculate at the point of indifference. The question reads, calculate the EBIT and EPS at the point of indifference. Solution. At the point of indifference, at the point of indifference, at the point of indifference, the EPS of option 1 is equal to the EPS of option 2. That's a formula. At the point of indifference, the EPS of option 1 is equal to the EPS of option 2. And we've defined the point of indifference. We've said that the point of indifference, the indifference point, is the EBIT level at which the EPS is the same for 2 or more financing options. So that at the point of indifference, the EPS of option 1 is equal to the EPS of option 2. Where do we get the EPS for option 1? Workings. EPS the formula is somewhere here. EPS. We say that where a company has 100% dividend payout ratio, all these earnings, after deducting interest, after deducting tax, after paying the preferred dividends, whatever remains, the earnings, if you divide by the number of ordinary shares, then you get your EPS. So EPS is equal to this total divided by the number of ordinary shares. Earnings attributable to ordinary shareholders divided by the number of shares, that will give you the EPS. So EPS here is equal to EBIT minus interest minus tax divided by the number of shares. EBIT or EPS is equal to EBIT minus, look at my illustration here, this EBIT minus interest. See, I've deducted interest here. So it is EBIT minus interest. So this is EBIT minus interest, I. All right? Then we deduct the tax. The same as multiplying EBIT by 1 minus T. Does it make sense? 1 minus t. We multiply this 1 minus t. We deduct the tax. So it is EBIT minus interest minus tax. So then you have earnings after tax. So to get that earnings down there after tax, we need to have the earnings attributable to ordinary shareholders. Earnings attributable to shareholders is equal to EBIT minus interest minus tax. This question has no preference dividends. It is interest minus tax. Then we divide by the number of ordinary shares. So we divide all this by the number of ordinary shares. Let's abbreviate it as S. If you want to abbreviate it with your name, it's okay. You can abbreviate it as A if it is Abraham, where A represents number of shares. This one I put S. This is S for number of shares. S. Okay. So EPS is equal to EBIT minus interest minus tax. Let me just put minus preference dividend. If there are preference dividends, we deduct preference dividend. There are no preference dividends in this case, but if we had preference dividends, we deduct. Then we divide by the numerator here is the earnings attributable to the ordinary shareholders. We divide the total earnings attributable to shareholders, we divide by the number of shares. That will give us the earnings per share. The earnings per share. So for EPS1, option 1, the earnings, therefore, earnings per share for option 1 will be equal to EBIT, which is unknown. EBIT is not known. We are not given EBIT in this question. So EBIT is unknown, X. Do you see that? From the question, do we have EBIT? No, we don't have EBIT. So we have to deduct this EBIT with interest. What will be the interest for option 1? Look at the question. Option 1, 12% debenture stock. 12% debenture stock. But we read Donald has a capital structure that consists of 150 million shillings, 15% debentures. So the interest is 15% of the 150. So it is 15% times 150 shillings, 150 million. That is the interest for option 1. The debenture interest is 15%. Do you see that? That is from the capital structure. The capital structure is 15% of the 150. Then there is the additional. Look at additional financing. The company will issue 12% debenture stock. Do you see that? And the amount is 20 million. So the additional funding there will be 20 million and the interest is 12% of the 20 million. So we have this plus, we add 12% of the 20 million. Do you see that? The 150 is in the capital structure, 20 is the additional. The one in the capital structure, the rate is 15%. The additional one is 12%. That's the total interest. That is our I, interest. Then the corporation tax rate is 30%. So 1 minus 30 is equal to 0.7. So these two, we multiply by 0.7. 1 minus 30%. There are no preference shares. So there is no preference dividend. We divide all this by the number of shares for financing option 1. What is the number of shares? The number of shares. Option 1. Look at the ordinary shares. We read the capital structure. We read that the ordinary shares is 450 million shillings of 20 shillings per value. 20 shillings per value. 20 shillings per value. Now for option 1, candidates, option 1, look at option 1 is the issue of 12% debenture stock. So the ordinary number of ordinary shares will comprise of the ordinary shares in the capital structure before the financing, and we have 450 million shillings. So this we will have 450 million shillings. We divide this by the par value. What is the par value? It's 20 shillings. So these are shillings and these are shillings. This will give us the number of ordinary shares. And given that in option 1, candidates, pay attention. In option 1, there'll be no additional shares. So we are not going to add any shares here because the 20 million will be raised through debentures. There are no additional shares. So that's it. Please simplify. Give me a simplified form of this. EPS 1. Simplify. Should be X minus something. Because I know 450 million divided by 20, that should be how much? So we have X minus, is it 24.9? 24, Muslima, 24.9. Just give me these two. 15% of that plus 12% of 20. Is it 24.9 times 0.7? Is it? That what you are getting? 450 over 20. What is 450 over 20? It's 22.5 million. Just leave it at that. Then we move to EPS 2. EPS 2 candidates will be equal to the unknown EBIT minus the interest. What is the interest? Second option, there will be issue of additional ordinary shares. Additional ordinary shares. So EPS 2, first of all, you have the one in the dividend, the interest, the debenture interest in the capital structure is still 15% of 150. That one stands in both financing options. The debenture interest in the capital structure is 15% of 150 million. then there'll be no additional interest because there are no debentures that are issued under the second option. Second option is just issue of ordinary shares. So there is no additional interest here. So it is just 15% of 150. That is the interest. Then we multiply it by 1 minus t. 1 minus t. So this is 0.7. You see that? There is no interest in option 2 because in option 2, the company will issue shares, not debentures. And if the company is issuing shares, the number of shares, you will see the change. We have the shares in the capital structure of 450 over the 20. Then there is the additional shares. Additional shares, issue additional shares of 20 shillings per value, and the value is 20 shillings. So we will have 20 million over 20 shillings. So this will represent the additional shares. So simplify. So you have x minus what? It's 22.5 million. We multiply by 0.7. Divide by these two. 450 over 20 plus 20 over 20. Number of shares. Of course, it will be 22.5 plus. Load says 23.3. It's 23.3. 23.3. So this is EPS 2. EPS 2. I think this we can simplify it further. What is 24.9 times 0.7? 24.9 times 0.7, what is it? So this one, let me just write it here for the sake of revision. So this is 0.7x minus 17.43 divide by 22.5 m. Then we'll divide by 23.3. It's minus what? 15.75? 15.75. So these are the two equations. This is equation 2 and this one is equation 1. EPS 1 is equal to, the EPS is 0.7x minus 17.43 divided by 22.5 is equal to EPS 2, 0.7x minus 15.75 divided by the number of shares, 23.3. So we only have one unknown here, x, which is the earnings per share. I mean the EBIT. This is EBIT. So to calculate the value of x, we will do cross multiply. We'll cross multiply 0.7x minus 17.43 times 23.3 is equal to 0.7x minus 15.75 times 22.5. The denominator is EPS2. What do you mean? EPS2 is 23.5. 23.5. EPS2 23.5. 23.5. So expand. Then give me the value of x. Expand. Give me the value of x. (23.3) into 0.7x minus 17.43 is equal to 22.5 into 0.7x minus 15.75. Remove the brackets. Get the value of x. X is equal to EBIT, which is equal to 78.9 million. Is 78.9? Is that what you are getting? Yes, 78.9 million. So that is EBIT. But it is not EBIT that we are looking for. We are looking for EPS. We are looking for EPS. So we can use this equation to calculate the value of EPS. So we know EPS using, let me say, using equation 2 to determine EPS. We'll then have equation 2, which is 0.7x minus 15.75 divided by 23.5. We know the value of x. This is equal to EPS2. This is EPS2. We now have the value for x. So EPS2 will be equal to 0.7 times 78.9 minus 15.75. We divide it by 23.5. Give me the value for EPS. What is the EPS? We have chosen equation 2 to calculate EPS at point of indifference. So EPS at point indifference will be how much? 1.6568. So therefore, at the point of indifference, EPS is equal to 1 shilling and 68 cents. EPS, that means this is 1.68 shillings per share. I don't need to write per share here because I have it here. Just to emphasize, this is 1.68 shillings, not millions. If you are to use equation 1, you'll still get 1.68. Because you recall what we said about our definition of indifference point. We said that it is the EBIT level at which the EPS is the same for 2 or more financing options. So at the EPS of the EBIT of 78.9 million, the EBIT for option 1 of 78.9, and the EBIT for option 2 of 78.9, both these two, at that level the EPS is the same, and it is 1 shilling and 68 cents. So when you are tasked to evaluate the impact of different financing options on a firm's EPS based on EBIT, this is what you do. The analysis will involve determining the indifference points where the EPS is the same for all the options. Do you understand?